Howdy, Team 42. It's your skipper here, Darius Dell, to present another episode of ProtoPro Live. I'm joined with our friend BEth Kindig, lead tech analyst at IO Fund. How you doing today, Beth?
Very good. Thanks, Darius.
It's a pleasure to have you. So for those among our audience who may not be familiar with you, give us a little bit of a background and some of your bio and what are you guys doing for your clients over at IO Fund?
Sure thing. I'm a tech analyst, and the best place in the world to learn tech is, of course, Silicon Valley. I worked there starting in 2011 and began to write deep dive white papers, stage appearances, places like Black Hat, Advertising Week New York, Android Developers Conference, to help technologists integrate technology, choose among dozens, perhaps, of cybersecurity companies. That's one area I worked in, or thousands of ad platforms. That's another area I worked in. How do you choose which one to integrate? These vendor deals are about single-digit million, sometimes double-digit millions. And it was pointed out to me that if I'm effective there in Silicon Valley, talking to technologists, what if you were to take that to Wall Street, where there's billions on the line, helping investors choose out of dozens of cloud companies, navigate a complex supply chain, whatever it might be, helping them navigate that. What would that look like? So I tried it in 2018, and right out the gate, it went very well. It was 2018, I said NVIDIA would be an AI stock. Clearly, that worked out quite well. Microsoft Azure, I said, would rival and maintain and become a strong number two based on hybrid cloud computing. Fast forward, that worked out. These are all just some blogs I put out very quickly on the side. And then I also said, be careful of Facebook. This was a Wall Street darling in 2018. It was very bold. And 2 months after I said, short it or be very careful of buying it, it reported the biggest loss in Wall Street history in one day. I lost about 25% from that earnings report. And that was due to the intricacies of how they collect data. So those are just some examples. Obviously, 2018 was a long time ago. We've had other notable wins, quite a few of them since then. But that's really how I got my start in Wall Street. Since then, I've gathered a team. The team is, if you can think of a football team, each one has unique strengths. The portfolio manager is in charge of active portfolio management. He's a technical analyst. He is the risk management side to the company. We also have your traditionally trained financial analysts. They help me after hours. We put out very unique insights on earnings reports. We also put out real-time trade alerts. We're champion transparency. We've spent over $150,000 on transparency. That includes, in the last 5 years, that includes real-time trade alerts through Twilio, mobile phone, backup email in case that system goes down. And we are independently verified by a large firm in San Francisco. So we're doing a lot of unique things in the tech space, and that's resulted in 131% cumulative returns in 4 years. Compare that to popular tech ETFs. I'm sure you can imagine which one I'm talking about. It is negative in the same time frame. So we're up over 130%. We also exceeded the NASDAQ by 50% in the same time frame. The NASDAQ has performed quite well over the last few years. So very proud of my team, and we think it's just the beginning.
Oh, I'm really proud of you guys. Those were some incredible calls. I mean, I didn't even know what NVIDIA was, 2 or 3 years, maybe 3 or 4 years ago. And obviously calling out his AI company back in 2018 is a hell of a call, as is, calling for Azure to become what it is, which is obviously a very dominant cloud service provider. So congrats on that. Talk to us a little bit before we even dive into your current views. We're big on process here, 42 Macro. It's in our opinion that the process is what determines luck from sustained success. And so, what about talk to us about your process? How do you go about generating these ideas?
We are very disciplined in that we will take a tech trend. This is where my experience comes into play, which is that I was already having to identify trends that would do well in a very competitive space. Like I said, Silicon Valley, most competitive space you could be in. And we will put that to the test. First and foremost, there's no reason to believe that a tech trend will do phenomenal, will provide phenomenal returns unless the earnings results are supporting it. We are very big on key metrics. We're very big on running through earnings reports, numbers. We love accelerating revenue, of course, but expanding margins, increased cash flows, things of that nature. From there, we hand it over to the portfolio manager, Knox Ridley, who is very trained in technical analysis. And he is looking for technicals that support a bottom or perhaps a breakout. And by the time I call it, something like the three cherries, if you're thinking of a slot machine, by the time that I truly believe in a tech trend and have leveraged that experience, by the time that we've ticked over 200 boxes on our fundamentals process, we have about 200 rows on our Excel sheet. And then you give it to the portfolio manager. And by the time that he likes those technicals, if that all lines up, we're ready. And we have that diversification within the team across skills and strengths so that once we do agree, we know, okay, this is something very, very important to do. From there, if a stock does not perform the way that we expected, we cut it, we don't look back. We're very disciplined in that manner.
Beth, you are this is music to my ears, and this is something we try to talk to our clients about, particularly on the retail side, because our institutional clients understand exactly as what you described, which is you keep your research separate from your risk management. And when your research and risk management are in alignment, that's obviously when you guys take positions for your clients. Colin, if you throw this slide 6 on the screen, where we just show our macro risk management process, this slide is in Beth in every piece of 42 macro research that we produce, because we want to consistently remind the client that, hey, what we're talking about with respect to the fundamental outlook for the economy, the fundamental outlook for policy, all the things about what's going to happen in the future has no official bearing on exactly what we want you to do on the portfolio. We're trying to help you identify and prepare for market regime change. And it sounds like you guys are using a fundamental analysis to help your clients identify and prepare for regime change in the actual securities. But ultimately, you need the technical overlay that your portfolio manager provides to actually get in and out of positions. And so I'm really grateful to hear another institutional investor, so to speak, like that, because again, this is stuff that I've seen across my career, meeting with institutional investors, throughout my career on Wall Street. This has been a consistent hallmark of all the best funds, the funds that are outperforming and are obviously, have the most, the greatest pedigrees in terms of their impact on the industry.
Yeah, there is some crossover. The portfolio manager, he follows you and said that you did an amazing job in 2022 of calling that bear market and then saying 2023 would be a great bull run, basically. So I'm aware that your process overlaps enough that he's aware of that success of yours.
Well, I'm grateful for that. I appreciate that. So let's keep it moving here. So let's bring it fast forward to today. I'll give you a big 30,000-foot jump ball question. We'll sort of drill down from there. Where are we in the tech cycle? Where are we in the AI cycle? Because that's obviously what everyone wants to know with the volatility that we've seen over the past kind of 6 to 8 weeks in the stock market.
Where we are with the tech cycle is, let me put it this way, over the next 3 to 6 months, we're not buyers. We're more likely to be selling into the rally that the minor rally. I was not a rally to chase. We think the market will move up into October, November, somewhere in there, and we will be selling into strength. We have price targets. Some of our stocks are reaching those price targets, getting very close. It's more likely we raise cash, wait for a sell-off, buy some of these very quality names lower. So in terms of the tech cycle, this is not a time we're buying.
Yeah, that's an interesting take. I wouldn't say a hot take, but it's certainly a warm take. And the reason I say it's a warm take is because when you think about sort of where we are in the broader economic cycle, generally speaking, when growth is starting to slow, it tends to favor your higher growth, type securities, particularly mega cap growth as a style factor. That tends to outperform, cyclicals and other pockets of the market when, investors are concerned about growth as they are today and are likely to be over the medium term. So walk us through sort of how you get to that view where you're expecting to be selling into strength, which obviously implies you think there is a deeper correction on the horizon as we get into the first part of next year.
Yes, I think it's more easier for me to talk more specifically because we specialize so very deeply into very certain names. Let's just talk NVIDIA. It's a stock we know very well. We ultimately think you can get NVIDIA lower than where it's trading today. We are likely to take gains between 120 and 150. This is from work that is primarily based on technicals. But if you look at the valuation has finally caught up to the fundamentals. There was a time when I was speaking about this stock where I kept saying this thing is very low. This valuation is very low. It kept coming in 300%, 400% EPS growth, even up to 600%. Very hard for a valuation to catch up to that. But now it has. And if you look at the valuation, it's looking toppy. And we have about 6 to 9 months before Blackwell arrives. Blackwell will exceed Hopper. And
For
so
those who may be familiar, what is Blackwell?
Blackwell is the new generation of GPUs that will allow for training trillion parameter large language models. So there's two words, if I can, there's two words that NVIDIA investors should know. Hopper, which is the generation that gave us all the gains and that big AI moment that you've seen most recently. And Hopper brought to market ChatGPT because it has a transformer engine. So that piece, you've seen those gains, you've seen this skyrocketing of earnings and revenue. Blackwell is the next generation of GPUs, and it arrives next year, 2025. And what Blackwell does is lowers total cost of ownership by 25x, leverages memory a little differently by combining a CPU and a GPU. You can run large language models in memory. And lastly, it combines 36 GPUs and 72 GPUs to think like one. So now you can go, the bottleneck that is happening in AI development is now moving forward with Blackwell. So we have some time. That is a long time to a tech investor when you have a stock trading at high valuation and you have your technicals guy saying this was the price target where I thought this stock would top all along a year ago, maybe more. It could maybe stretch to 170. We think that's getting to be very high risk. The probability favors us buying it lower. So we're actively managed. That's the active management piece, meaning we don't just white knuckle long-term buy and hold. Couldn't have a higher conviction in NVIDIA. That gives you an example of actively managing. We bought NVIDIA at the low in October of 2022 with same methodologies. I would like to repeat that
No, of
if
course.
possible.
Like a repeatable process pays for
Yeah.
it many times over if it's good.
Yeah.
So that's a heck of a call. That's a bold call. I mean, I think about, my simplistic, non-micro hat, when I think about earnings, if you have a catalyst on the horizon, certainly within a next 12-month time horizon, that is clearly and obviously positive for earnings, I think it feels like you're playing with fire by sort of, being tactical in that context. But in the context of everyone obviously being already extremely long and exposed to NVIDIA, perhaps that's not the case. I'll throw a slide on the screen here, and I'm actually interested in your take because, I feel like this might be a hot take. It certainly feels hot from my perspective because we spend very little time discussing valuation here from a broad market signaling perspective because our research has shown that valuation tends not to have much of an influence over asset markets on the time horizons that we macro folks tend to focus on, which is generally speaking inside of 1 year. And so what we showed here in this chart is the conclusion of the chart is obviously that tech and comm services valuations, when you combine them, are roughly aligned with where they were in the dot-com bubble. And we're showing this on a trailing 12-month earnings price to earnings ratio basis. That's the top panel here. We show this on a trailing 12-month price to sales basis here in the second panel, and then we show it on a combined market cap divided by S&P market cap here in the third panel. And so obviously on a price to earnings basis, with so many more earnings obviously being generated by these companies are all incredibly cash flow positive now. We're probably not going to get back to the level of price to earnings that we saw back at the height of the dot-com bubble, at least not over the medium term. But we have already eclipsed the trailing 12-month, the peak price to sales ratio that we saw back in the height of the dot-com bubble, and we're right at the combined market cap for these companies as a share of the overall index at about 39%. So, these are some pretty lofty levels, and they obviously imply that the mean investor, the median investor, is obviously well exposed to these names. And so, when it comes to something like Blackwell, you're essentially saying, in the absence of good news is a bearish catalyst. I assume that's kind of the key takeaway. in terms of this kind of 6 to 9 month, blackout period, if you will, for BlackRock. Is that kind of the key takeaway there?
Yes, that is the key takeaway, and has everything, over the next 2 to 3 quarters, reasonably speaking, been priced in? Are we reaching a valuation where the stock has not shown historically it can hold that valuation? And then it goes back to those technicals, which we've done well with because tech is so sentiment driven. It responds to technicals a little bit better than other industries. So that combined process, I can give you another example, kind of shocking for us, the firm, we closed Microsoft in July. I could not be more bullish on Microsoft, next 10 years. The valuation was at a point where it can't sustain and the technicals were flashing. And this is kind of what happened, I think, with the Mag 7 in pockets, is that they were getting overextended. The market clearly favored the Mag 7 over time. All of the, you fly up 100%, 200% returns thinking of something like Meta or Tesla, and you're going to see people take gains. You're going to see them move to the sidelines and wait for it to go lower. So that, like, those extreme moves require, in our opinion, a more active stance. And it's less about how much conviction do you have in Microsoft, and it's more about, can we get Microsoft lower? What is the probability here? And if it's lower, then your returns exponentially go up at times. Maybe not with Microsoft, but the difference between buying NVIDIA in October of 2022 versus your standard first of the year, we've done the math, 1,100% versus 400 or 500%. So now you've doubled your returns by being a little bit more careful on your timing. So that's kind of how we play it.
That's an outstanding call to exit Microsoft. I mean, I assume that was the high for the stock. When you say the valuation reached a level that it could not sustain, that sort of beckons the question: what is or are your favorite valuation metrics? Because obviously everyone does, everyone's got their own little sauce and whatnot. What do you guys like to look at that's the best leading indicator for how stocks might perform over medium-term time horizon?
You're probably noticing I'm smiling right now and trying to hold back a laugh because we've had well-trained financial analysts come in and they will get quite fancy with valuations. I come from, like I said, I come from Silicon Valley. The common denominator in tech is revenue. And there are, of course, moments where you've got to check the bottom line. Revenue valuations in tech tend to move very closely to that common denominator. There was an expert in cloud. He puts out a newsletter every week. And one day he addressed this topic because he kept getting these questions, and he aligned with what I said, which is that the thing about tech you have to understand is that there are these public market valuations, but there's also private market valuations, and they do work together. Even if Wall Street is in one corner of the country and venture capitalists are in the other corner, they do actually eventually become public companies, et cetera. And venture capitalists have to use revenue because these are companies that are not profitable yet. And so that common denominator across private, public, everything combined is revenue. And we are very, first and foremost, it's revenue. Obviously, we want to see cash flows, but the problem is that the minute a company becomes cash flow positive, the market piles in. There's no valuation metric that's going to help you there because the cash flows are very nominal at that time, but it's significant that it's now cash flow positive out of, say, a cohort of 10 to 15 peers. Same with GAAP profitability. It can be very notable and significant when a tech company becomes GAAP profitable for the first time. But if you're looking too closely at PE ratios or getting more involved there, the problem is that the P ratio won't look right. It'll look very high into the hundreds because it's so newly GAAP profitable. But it's a moment where investors will buy. So those are why some of the other valuations won't always work, and technically growth does work.
Gotcha. That makes sense. I appreciate you explaining that. So going back to the chart on slide 53, it seems like panel number 2 would be most in line with how you guys think about the world, which is price to sales ratio, and that multiple now is actually currently exceeding the mean price to sales ratio that was observed between the tech and comm services sectors at the height of the dot-com bubble. So that feels worrying, but again, valuation, at least according to our analysis, is not necessarily something you want to lead with as a market strategist, but it can obviously work on individual stocks much better, given that, stocks trade in the, you have specific comps, specific peer groups that you can actually compare different stocks to. So that's your view on Microsoft and on NVIDIA. Those don't sound like you're explicitly bearish. It just sounds like you're being, price sensitive in a way that, might help your fund generate better returns in the future. Walk to me about, so in case the markets do take a turn for the worse, if obviously these stocks, if you can assume these stocks, you can buy these stocks lower, they're going to take the broader market down just in terms of their share of overall market cap. And so walk me through maybe one or two of your favorite short ideas here that you actually think the fundamentals will justify a deep correction in those securities.
Okay, so let me preface to say we don't short stocks, but what I can tell you is where AI is most threatening and most looming is with cloud. And I can give you an example most recently. So when you hear these, so for us, AI is the biggest opportunity to invest in our lifetimes. And if you look at the estimates, and I'll get into why specific cloud companies could make a good short, is that McKinsey and Gartner and all of these others, every time you go to check back every 3 to 6 months, their estimates keep going up and up and up in terms of the impact AI will have. So they're saying now it's 4.4 trillion in global profits. Where is that all going to come from? Well, Klarna, most recently, is a company that does buy now, pay later, and it's a private startup unicorn. I think it's worth about 7 billion. So they have a very sophisticated tech stack. They recently announced they're going to eliminate Salesforce and Workday because they have created custom large language models that they can now integrate into a lighter tech stack that's custom for themselves. Rough math on this is maybe single digit millions, let's say 3 to 5 million, maybe even 7 million on training that model, integrating that model, versus tens of millions at times for Salesforce and Workday, your SaaS contracts and subscription contracts. So immediately that company, by integrating more of a custom large language model, removing these extremely expensive software products, has now become a more profitable company, or on its path to being profitable. I don't know its fundamentals because it's private. Much higher chance it'll be profitable by cutting out those expensive expenses and using AI instead and automating it. Perhaps it's poetic justice that the first industry that AI will disrupt is tech, is cloud software, in my opinion, engineers, developers, programmers. That is where to look, in my opinion, for companies that you never thought would ever go out of business are suddenly extinct. And that's why, because they're easily replaceable by AI.
Wow. So not saying that you think these particular companies will go out of business, but do you have any companies that come to mind that you think will be incredibly disrupted? You mentioned Salesforce and Oracle. Do you have any others?
Salesforce, Workday, we haven't looked at it from that side. We're more positioned to look for those that are eating the world, conquering the world. And we're more interested in that piece because you can go up a lot more than 100% compared to your typical short, your most successful short. So I would say I have not done that analysis to the point where I could articulate it right now as to which company, other than to say, if you were to ask me what is the biggest threat from AI, it would be those many best of breed cloud companies that are sitting on the market. There's all kinds.
No, that's very helpful, and also very helpful. You said something that really resonated with me. I'm not sure why, so I'm going to unpack it. I would like you to unpack it. But you said AI is the best investment opportunity of our lifetime, and obviously our lifetimes very much include the internet. And so walk me through how and why AI is a better investment opportunity than the internet?
Okay, that's a great question. The internet is a protocol. It's open source. It is extremely democratized, always has been. You could put up a website, anyone could put up a website very quickly. Nobody owns the internet. AI, complete opposite. It's proprietary. Not only these companies own the large language model, they may at times open source it, but it's corporate owned. OpenAI, of course, owns their models. Meta does own Llama. They open source it, but it's proprietary and it's their model. Uh, Barrier to entry could not be higher for AI. Barrier to entry could not be lower for the internet. So again, any average Joe or Jill could put up a website. The amount of people or amount of companies or amount of businesses that could train a large language model are very few. It's extremely expensive, millions of dollars. On top of that, we obviously have a shortage of GPUs. So even if you have all the money in the world, which a lot of these companies do have large cash reserves, it's still hard to get all the GPUs required in order to build these proprietary large language models that hopefully will prevent their extinction and instead will create a winners take all market. So when I think about the internet, I would go toward crypto or Bitcoin as a protocol, Web3 being a little more of a apples to apples, where I don't see any parallel between AI and the internet for those reasons, sort of a 10,000-foot view.
Oh, it's really helpful. I appreciate you kind of breaking that down from a technical standpoint. When you think about AI, so one of the things that I think the market has general angst about is the speed with which AI applications are being developed, and really, I would say the lack of speed with which they're being developed. So thus far, the gains have been largely concentrated to the picks and shovels. In terms of the AI related gains, obviously we've seen a lot of tech companies do well, but that's primarily because their legacy software businesses are doing well. When we talk about the sort of the future AI from an application standpoint, what are the types of things that maybe don't exist today or only exist in a very nascent form today that will be just part of how we do business in the world, let's call it 2 to 3 years from now?
Yes, what Microsoft is trying to develop, and Microsoft is a great company to keep an eye on because from my perspective, I said this years ago, it seems to be playing out that AI is an enterprise technology first and foremost. It'll be years from now before it hits consumers. And who is an enterprise bellwether? Microsoft. And when you look at what they're doing, they're creating a Copilot, which is an AI assistant that leverages data from your own computer or your own company, and it starts to get to know you on a more custom level. And all that digging around, I give you probably something that will be happening in the next 1 to 2 years. All that digging around for files on your computer, gone. All that digging around for emails and trying to find those documents that, from a week ago, a month ago, that will be removed. You'll just say, hey, Copilot, find the Dariusdale email where we chatted about timing for the interview, and it'll pop up, rather than me going through and looking for it all. Those kinds of productivity things will happen at the consumer level. I would look more for those big moves on, operating expenses that startups and companies can quickly eliminate through AI. And it's like that Salesforce example, which has been theoretically the reason AI is so important right now is because it can remove those high costs. And we're already seeing it happen. And so what I would also say is that when you think of the big three, AWS, Azure, and Google Cloud, they are almost fighting. I don't want to put it in these dire terms like they're fighting for survival, they're going to go out of business, but they're fighting for relevance to some extent. Who will be the most relevant in the new AI economy? And they have to be first, maybe second, but not third, because once people integrate these technologies, the switching costs can be quite high. Once you train them, once you use, let's say, a model that's hosted on Azure, the chances you change are pretty low. It takes a lot to change your cloud infrastructure as a service. We started our company 5 years ago. We use Google Cloud. I can't imagine, paying for that change or that in time and resources. And we're 10 people company. Imagine if you're thousands. So they're racing for that reason, that it would be unlikely or hard. Switching costs would be high to change your AI infrastructure down the road. So I would kind of think about it from that piece all the way down to someday the consumer will be using these features. But Apple, for example, not my favorite AI play. Microsoft all day long before Apple, and it's because of those enterprise use cases.
Gotcha. Why not Apple?
Consumers going to be tougher, in my opinion, for AI. AI is expensive. You're going to have to pay for it. And consumers they're not replacing tens of millions out of operating expenses by adopting AI. It's a harder user adoption curve than enterprises, which have an immediate upside, technical engineer departments that can work with these, AI and make it have that return in what I would call Wall Street's definition of near term to medium term. There's a lot of development that still needs to happen in order for those perfect consumer apps to come out, cost the right amount, and be exciting enough to the consumer, because consumers don't really have a productivity need. I would almost argue they lack productivity to a high degree. I mean, social media is such a productivity waste. So when you say to them, hey, you're going to be more productive, they're like, well, I don't really care. I spend 5 hours on Instagram. But, the companies are thinking, if I could eliminate checking email, that would maybe save an hour per employee. How much do these employees make, et cetera, et cetera. So considering that, in my opinion, AI is first and foremost designed to increase productivity, not sure consumers care to increase their productivity. If you look at social media trends, pretty unproductive these days. I hope that makes sense.
No, that's great. So, no, that makes a ton of sense. I too share skepticism with respect to Apple's rollout of AI, but again, I know absolutely nothing. I can't tell my foot from an elbow, so I don't want to be the lead analyst on that. With respect to enterprise AI, when I think about businesses, I sort of think about them. There's kind of four main functions that every business has. It's the product, obviously. There's marketing, there's sales, and there's customer support or customer success, or whatever we call that. Is there a ticker that you can sort of a company or a ticker that you can sort of assign that's going to be like best in class, best in breed for delivering AI to support each of those four functions, and maybe four different companies?
You're going to get very bored with me, but Microsoft is one that's getting there. Yeah.
Yeah,
Microsoft is getting there pretty quick. They have the cash to leverage and get there very quick. And from there, a lot of investors want to avoid this, but you can't, is that hardware is where the AI gains will be over the next few years.
Really?
If you compare, actually, if you go back and look, so I would go hardware, supply chain, things of that nature. If you go back and
more NVIDIA, is that what you're saying? Just more.
I'm sorry.
More of the NVIDIAs of the world.
Yeah, but let me illustrate, because I think that people are saying sometimes .com, Cisco, et cetera. But if you go back and you look at the mobile era, which gave us Apple, Google, because it's pocket phone is now in your pocket. So now you have Maps, Google search engine exploded, things like that. It's everywhere you go now, not just stuck to a desktop. Facebook, of course, mobile. Broadcom exceeded them. So it's like we've seen this before, where a hardware company that's picks and shovels supplying the more consumer facing stocks has exceeded what in our minds as investors are the ideal investment. However, AI is really very much a hardware combined with software problem, but software at the hardware level. It really is that part of the stack. And there are many companies in that stack. There's no shortage of companies in the supply chain stack. That's another area that I think will continue to lead for the next few years. We haven't even begun.
Haven't even begun. What's your favorite ticker in that space?
One that's perhaps more unique is Dell, which is the total dinosaur.
Back from the dead. Talk to me.
Yeah.
Yeah.
Definitely not my coolest recommendation, but Dell is a supply partner to NVIDIA, and Dell's moment will come with AI enterprise. So there's the hyperscalers, there's Microsoft, Google Cloud, Amazon, of course, Oracle, but then there's enterprises, your Fortune 500s, and similar to what Klarna did, which is they want to customize their own models, integrate them, get rid of that tech stack, get rid of those big, very expensive pieces to the tech stack. That's Dell's market. That's Dell's market. Dell is going to own the AI enterprise server market. Now, when you go back to the discussion on Blackwell, which is total cost of ownership being 25x better than the previous generation, which is very important because AI's power consumption is extremely expensive. There's something called liquid cooling that Dell will provide. There's others that provide it, but Dell is in that space, and that's a great space to be at in the supply chain because everything coming out in terms of Blackwell will be moving toward liquid cooling to lower that cost of ownership from power consumption. So Dell's in that space, which is great. Love someone downstream from NVIDIA's Blackwell, love a stock downstream from that. They're also in AI PCs, and I know it's hard to believe that PCs would be an investable segment, but they're going through a major upgrade, and there's going to be buttons for Microsoft's Copilot on the PC. There's all kinds of changes. Neural processing unit, NPUs are basically combined with CPU and GPUs to finally bring to market AI features on laptops. Now, we're going back to the consumer question. Do consumers care? Do they want to pay a lot? Doesn't matter as much because corporate companies will buy those laptops for their employees in order to improve that productivity. So now we're back in that enterprise space that I like to be in. So it's just interesting because they're in a lot of areas right now. They're fairly safe stock. They're one of their competitors, Supermicro, high beta, much riskier. Certainly been a thrilling ride, but it's risky compared to Dell. And when you think of a safe stock that has great management, that's in all of these different segments that are about to move and, see growth, we like Dell.
I like it. Well, this has been great, Beth. Let me try to summarize what I learned in short order to make sure the audience has it. Laugh at me and tell me I'm wrong if I get any of this wrong. So number one, you think you can buy your favorite AI, your favorite tech names, broadly speaking, at lower price points than we're currently trading, so that you have a risk management program on that's attempting to do that. And then you prefer enterprise over consumer and hardware over software. Those are kind of the three big takeaways from your presentation that I gleaned. And obviously, names like Dell, those are the types of names that you really like from that perspective. Did I get that right?
Yes, we are not trimming yet. So we're in a holding pattern. We're not buying and we're not selling yet, but most likely next actions would be selling in the next 3 months.
That makes sense. I appreciate you clarifying that. Before I let you go, I got to ask you my favorite question that I ask all of our guests here, which is, what's one risk management lesson that you live by now that you wish you knew at the beginning of your career?
Wow, there are a lot of them. I don't know if I can narrow it down to one. I guess a few that come up for a tech portfolio is diversification is not your friend in tech. It took thousands, tens of thousands of companies to create the FANGs. If you think you have a FANG, we have found allocating up to 20% is a great strategy. If we are looking and talking to ETF distributors right now to see if that would be a good idea for our company. And we looked at AI ETFs that basket 50 names. They underperformed the NASDAQ during the AI boom. Not a good idea. There's no reason to underperform the NASDAQ during an AI boom if you are positioned for AI. The other one is broad market. I can't emphasize enough broad market for tech investors. This is a risk management tool because if the broad market doesn't say go, the chances a tech stock defies that and does well or is pretty low. The tech really needs the broad market to participate, and that is an important risk management tool. And then third, I'm going to throw out three. Follow those stops. We cut positions that we like very much. We talked about Microsoft, and we attempt to buy lower. We don't believe in long-term buy and hold for tech because of those sentiment-driven moves in both directions. So following stops is something I wish I had known early in my career. I know it now, and it's almost as important as picking the stock.
Yeah, no, the research and the risk management are two very, very separate processes. And, that's something that we talked about earlier that I think is appropriate to end on, because I think I can't hammer this point home enough to our retail investor clients. Just because you like something doesn't mean you need to be long it. Those are two separate things. And just because you don't like something doesn't mean you need to be short it. Those are two separate things. Those are four different outcomes: liking, longing, shorting, disliking. Those are four different things. You should only put those things together in your portfolio when the market agrees with what you like and dislike from a positioning standpoint. So I appreciate you reiterating that teaching, coaching lesson that we've been pounding the table on for the past 3.5 years for our clients, Beth. This was a wonderful discussion. We'll definitely have you back on the program if you'll have us. Learned a lot today, Beth. Appreciate you guys. Where can our clients go to find you and then what you guys are doing over at IO Fund?
iofund.com. Our flagship tier is the advanced tier. It comes with those trade alerts, weekly webinars, tons of deep dive research from myself, and fundamentals from a fundamentals team.
Awesome. Well, I appreciate that, Beth. We'll catch you next time. Thank you very much.
It's been an honor. Thank you, Darius.
Thank you. Cheers. Catch you guys here next month. Cheers.